Global oil demand has been faltering, but will it recover this year? Welcome to Market Insight. I'm Elena Casas. Crude oil has been losing ground in recent trading sessions, with Brent down to almost $77 a barrel as it's been pushed lower by stubborn fears about weak demand in China. US crude stocks are also expected to have risen when last week's figures come out later, putting further pressure on prices. So, is a recovery on the cards for the next quarter? To help answer that and more, I'm joined now by David Fyfe, Chief Economist at Argus Media. David, hi. I know you're revising down estimates for oil demand this year, both in China and globally. Why is that?
Yeah, well, thank you very much for having me on the show. We are in the process this month of cutting probably the best part of 200,000 barrels a day off Chinese 2024 oil demand growth. We've got barely 400,000 barrels a day out of China this year and about 1.3 million barrels per day globally. So we're a little bit above what the IEA is forecasting for growth this year. But having said that, China in particular has had a disappointing performance so far this year. Crude oil imports are showing really no growth at all into China. And all the industrial indicators that we've seen, industrial output, but also the real estate sector are really in a pretty bad way. And that's feeding through particularly into diesel demand, which is looking pretty weak. Now, the irony is that although we've revised demand down, actually we think global oil market fundamentals in the second half of this year look fairly tight, and we're expecting consistent stock draws. So yes, it's a little bit bearish on the demand side, but we think otherwise the crude complex should be relatively well supported, at least in terms of fundamentals.
Certainly, though, David, the geopolitical risk premium seems lower than it has been in the past, despite the ongoing risk of wider conflict in the Middle East. Why are you confident that those fundamentals will support the market?
Well, you're right. I mean, really, arguably for the last 2 or 3 months, to a certain extent, the price has been disconnected from underlying physical fundamentals, and it's been really based off, first of all, the US economy and what the Federal Reserve is going to do, weakness in China, and expectations or hopes for a peace deal in Gaza. It remains to be seen in terms of the geopolitical issue whether there is progress in the peace talks around Gaza. It may well be that risk premium could build back into the price as we head towards the latter part of the year, depending what happens, not only in the Middle East, but also, of course, in Russia and Ukraine.
Where does this leave OPEC Plus then?
Well, I think our perception is there was a lot of rumors about them discussing whether they should indeed start relaxing their production cuts in October, which is their plan. We think they probably will. We think there is a market for more OPEC oil, at least through until early in 2025. I think the problem for them is that later in 2024, market balances look a lot looser, and there's a risk of a surplus later on in 22 and 25. So the conundrum for them is, do they start increasing production now, only to have to cut it again to support prices later in 2025?
They've also, David, of course, lost market share to non-OPEC producers in the last couple of years, with the way that China buys oil in particular having changed. How much has that affected the long-term outlook?
Yeah, well, they're not only losing market share to non-OPEC producers like the United States or Brazil or Canada. Also within the OPEC Plus fold, we've seen both in India and China, Middle Eastern producers losing market share to one of their own, i.e. Russia. Now that Russian oil is shut out of Europe and North America, it's heading to Asia. So there's an internal dynamic there which could become a little bit more fraught particularly if the market begins to soften in 2025.
David Fyfe of Argus Media, many thanks for your thoughts. Well, that's Market Insights. Don't forget, you can watch more videos on Reuters.com.